Intel Corporation is currently trading around $20, significantly below its highs from previous years. Once a dominant force in semiconductor manufacturing and CPU design, Intel has seen its market position eroded by competitors like AMD, Nvidia, and TSMC. Over the past few years, operational missteps, delays in advanced chip fabrication, and a shift in consumer and enterprise demand have challenged the company. Its Q2 2025 results reveal the financial strains Intel is under during this turnaround phase. From a fundamental standpoint, Intel remains a revenue-heavy company with stable top-line performance. Q2 2025 revenue was $12.9 billion, flat year-over-year and slightly ahead of expectations. However, Intel posted a GAAP loss per share of $0.67 and a non-GAAP loss of $0.10. These losses were largely due to $1.9 billion in restructuring charges and $800 million in impairments. Operating margins remain under severe pressure, as gross margins dropped below 30%, a far cry from the mid-50% margins Intel once maintained during its peak years. Despite the bottom-line weakness, Intel maintains a strong balance sheet with over $25 billion in cash and short-term investments, although long-term debt has climbed to $45 billion. Largely due to capital expenditures in fabs and acquisitions, Intel continues to invest heavily in its foundry business and AI chips. While it has made some progress, it still significantly lags behind TSMC in advanced node technology. Intel's 14A process is still in development, with 18A facing production delays. The data center and AI segment saw modest growth, up around 4% in Q2, but it's not enough to offset declining margins in the PC client group, which still makes up a large portion of revenue. Intel's net profit margin is currently negative, and return on equity, ROE, is down to 7%, reflecting weak shareholder value creation in the short term. Its dividend yield sits at 2.3%, but recent cash flow pressures have raised concerns over future dividend sustainability. From a technical analysis perspective, INTC is currently trading near multi-year lows around the $20 level. The stock recently broke below its 50-day and 200-day moving averages, which are both trending downward, indicating a bearish long-term trend. Relative Strength Index, RSI, is near 35, suggesting that the stock is approaching oversold territory, but not quite at extreme levels. There is technical support around the $19.50–$20 range, and failure to hold this level could lead to a test of the $18 level, which was last touched during COVID-era lows. Resistance sits at $22.50 and again at $20. A sustained move above $25 would be required to confirm any trend reversal. But the stock would need strong catalysts such as a positive earnings surprise, strategic partnership, or AI-related growth acceleration. Intel's current strategic and financial position is best understood through a nuanced SWOT analysis, integrated with a detailed look at its cash flow health and capital structure. This paints a clearer picture of the company's stability during its turnaround effort. One of Intel's core strengths lies in its legacy dominance and brand recognition across both consumer and enterprise computing. As one of the few vertically integrated semiconductor companies, Intel has significant control over chip design and manufacturing, a model that can offer long-term scale and security advantages. Its massive R&D investment, nearly $15 billion annually, continues to fuel innovation across CPUs, AI accelerators, and data center chips. Additionally, Intel's extensive intellectual property portfolio and long-standing relationships with OEMs like Dell, HP, and Lenovo ensure it maintains a baseline of consistent revenue. Despite its struggles, the company still generates over $50 billion in annual revenue and remains a critical player in global chip supply. However, Intel's weaknesses have become increasingly prominent. Years of execution missteps, such as delays in its 10nm and 7nm process nodes, have eroded its technological leadership. Competitors like AMD, powered by TSMC's cutting-edge nodes, have taken considerable market share in high-performance desktop, server, and mobile segments. Intel's margins have also collapsed in recent quarters, with gross margin dipping below 30% in Q2 2025. Furthermore, the company's capital-intensive model has led to ballooning long-term debt, now over $45 billion. Compounded by recent multi-billion-dollar impairments and restructuring charges, Intel's net income has swung negative, raising concerns over the sustainability of dividends and return on equity. On the opportunity side, Intel is still well-positioned to benefit from secular growth trends in artificial intelligence, edge computing, and custom silicon. The increasing demand for data center capacity and AI training workloads provides an opportunity for Intel to leverage its Gaudi AI chips and build out its AI accelerator lineup. Additionally, the US government's CHIPS Act provides an important lifeline through grants and subsidies, potentially reducing the cost burden of domestic fabrication expansions. Intel's effort to re-enter the foundry business and serve external customers through Intel Foundry Services, IFS, could become a key revenue driver, provided it can deliver competitive performance and win major design contracts. The recent leadership transition, with Lip-Bu Tan taking the helm, also brings credibility and a disciplined approach to execution and capital allocation. Nevertheless, Intel faces significant threats. It continues to lag behind TSMC and Samsung in manufacturing technology, making it vulnerable in the race for high-performance computing dominance. This manufacturing gap not only affects internal chip development, but also impairs the attractiveness of Intel Foundry Services to potential external clients. Competition from fabless companies like AMD, NVIDIA, and Qualcomm, who can flexibly partner with best-in-class fabs, puts additional pressure on Intel's innovation cycle. There's also geopolitical risk. Any escalation in US-China tensions, export restrictions, or disruptions to Taiwan's chip supply could ripple through Intel's ecosystem. Finally, macroeconomic pressures like inflation, rising interest rates, and cyclical downturns in PC and server demand pose persistent external challenges. When it comes to cash flow, Intel is in a delicate position. In the trailing 12 months, the company generated about $6.4 billion in free cash flow, a significant drop from prior years when it routinely exceeded $15 billion. Operating cash flow has declined in tandem with earnings, largely due to higher cost of goods sold, lower margins, and cash outflows related to restructuring. On the investment side, capital expenditures remain extremely high, around $25 billion annually, as Intel continues to build and upgrade fabs in Arizona, Ohio, and other regions. This aggressive spending, though intended to support long-term growth, has forced the company to rely more heavily on debt and reduce shareholder returns. Intel has recently slowed buybacks and maintained its dividend at 0.50 cents per share quarterly, but any prolonged cash strain could put the dividend at risk in 2026 if profitability doesn't rebound. In terms of valuation, Intel trades at roughly 10 times forward earnings, adjusted, which appears cheap compared to industry peers. However, this low valuation is more reflective of market skepticism around its growth trajectory and earnings volatility. Intel's price-to-sales (PS) ratio is around 2.3, which is also lower than AMD, a 5.4, and NVIDIA, 8.18. But again, this reflects its lagging margin profile and weak EPS growth. Price-to-book (PB) is near 1.1, suggesting the stock is valued close to its net asset value, a sign of investor caution about its ability to convert assets into earnings. Investor sentiment remains largely neutral. Out of nearly 45 analysts covering Intel, the vast majority have a hold rating. Only a handful are bullish, citing potential upside from restructuring and long-term positioning in the AI and foundry space. Bearish analysts continue to point to margin erosion, high capex, and lack of competitive edge in current technologies. Average analyst price targets sit around $22-23, suggesting moderate upside, while more bullish forecasts extend to $26-28 in optimistic turnaround scenarios. In conclusion, Intel represents a value turnaround play with meaningful downside risk if execution falters. Revenue has stabilized, but profit margins remain depressed due to high restructuring costs, competition, and slower innovation. CEO Lip-Bu Tan's focus on discipline, AI, and select growth initiatives could gradually reshape the company, but the process will take multiple quarters, if not years. The current stock price may appeal to contrarian long-term investors, but sustained improvements in earnings, margins, and competitive positioning are essential to justify a strong buy thesis. For now, Intel is best categorized as a speculative hold with a neutral to cautious outlook.